you are using instruments, complex instruments, designed to tell you what occurred 10 minutes before you looked. Every line, every oscillator, every calculation that covers your screen is nothing more than a graveyard marker for a trade that has already concluded. They distract you. They divert your eye from the only data that matters, the actual, persistent, undeniable behavior of the asset itself. The market does not require complex mathematics to tell you its intention. It does not require a calculation of average movement over the last 15 periods. The market possesses a habit, a persistent, discernible behavioral rhythm. If you learn to read that habit, the ingrained action of the price, you will possess the only true indicator required for intelligent speculation. Stop calculating, start observing. Stop searching for signals created from derived data and look directly at the source. The truth is only ever found on the primary tape. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The habitual action of price, as we've discussed, must be learned, yet the cost of this education is typically paid through significant market penalties, levied against the unprepared account. To minimize this costly experience, the speculator must turn to primary texts. The definitive source remains the meticulous account chronicled by Edwin Lefebvre in 1923. Reminiscences of a Stock Operator, detailing the profound market education of Jesse Livermore, the man known as Larry Livingston. This book acts as a practical laboratory of experience, providing decades of concentrated wisdom without costing the reader a single dollar of actual capital risk. Crucially, to properly translate the unique pressures and psychological dynamics of that era into modern actionable strategies, the annotated edition by Max Davidson, featuring critical context and professional commentary, is absolutely indispensable. A link to this essential edition is provided in the description below. The fundamental flaw of almost every technical instrument devised by man is that it is derived from the price but delayed by its own necessity of calculation. Think of that truth. It cannot exist unless the price action occurs first. It is always trailing. It is always confirming an action that has already concluded, or is rapidly concluding. By the time the moving average turns upward or the oscillator crosses its threshold, the professionals who watch price directly, who read the primary tape with surgical precision, have already commenced their positioning. They have established their foundation. They are already moving their pieces because they needed no complex mathematics to tell them what was self-evident in the ticks. Indicators provide confidence. They do not provide accuracy. They provide the inexperienced speculator with a feeling of certainty, a mathematical opiate that justifies their late entry. They are designed, by their very nature of lag, to keep the average man engaged. They promise a signal, but that signal always arrives late. It is the inherent vice of technical derivation. If you are waiting for the indicator to confirm the move, you are waiting for the move to reach its maturity. You are entering the theater just as the curtain falls. If you are trailing the price action by even moments, by even a few necessary ticks of confirmation, then you are paying the tuition for those who read the primary action. You are the source of their profit. The money moves from the impatient to the patient, but more precisely, the money moves from the lagging speculator to the professional observer. You must accept that this mathematical delay, this lag inherent in derivation, is a cost that makes success exceedingly difficult. You must get rid of the instruments that cost you precious seconds of foresight. We must define what this habitual action truly is. It is not merely the trend, it is the path of least resistance. It is the persistent rhythm that the asset establishes after any significant event, after any news, after any large professional campaign has moved through. The habitual action is the market's inherent ease or difficulty of movement when it is not under external immediate pressure. Ask yourself, not by looking at your indicator lines, but by watching the price itself. Is this asset floating effortlessly upward? Or is every single uptick met with immediate grinding resistance? Is the price action light? Is it buoyant? Does it feel like a boat moving easily with the current of the river, requiring little effort to maintain its bearing? Or is it a struggle? Is the asset forcing its way through concrete, requiring constant, overwhelming input from buyers just to maintain its footing, just to prevent it from slipping back? That ease of movement, that cadence of the ticks, is the market's voice. It tells you in plain terms whether the asset is being broadly supported by accumulated professional interest, or whether it is being carefully, methodically distributed into waiting hands. Ignore the volume for a moment, ignore the news headlines, and focus only on the rhythm. The habitual action is self-evident. It is the character of the asset. If the habit is upward, the price must demonstrate a natural intrinsic flotation. If the habit is downward, it must sink with the inherent weight of water. If you observe struggle where there should be ease, the habit you thought was strong is in fact on the verge of collapsing. The lack of effortless momentum is the first, most critical indicator of a changing tide. The market never moves in a straight line, not in any speculative instrument worth trading. Every major movement, every advance, every retreat is followed by what I call the natural reaction. A necessary pullback, a brief period of rest, a testing of the conviction. The habitual action is not confirmed during the thrust of the movement. Anyone can ride a burst of momentum. The habit is confirmed during the reaction. How does the market behave when the pressure is momentarily lifted? That is the question of the tape. If a stock is deeply entrenched in an upward habit, it should react quickly but shallowly. It should refuse to breach what I call the critical pivotal point. The reaction should be a brief, nervous tremor before the larger move resumes its course. It should pull back just enough to shake out the weak, impatient money. It should pause just long enough to refresh the conviction of the strong. If the reaction is deep, if the stock retreats slowly, struggling to find support, losing significant ground relative to its recent gains, that is the most damning evidence. A deep, grinding, struggling reaction against the major trend signals one thing above all others. The market's habit is breaking. The line of least resistance is shifting direction. It means the professional money that supported the move has, for the moment, withdrawn its commitment. The reaction must be quick, decisive, and contained. If the reaction is protracted, the habit is failing, regardless of where your derived indicators tell you the momentum sits. A true habitual move is measured in time, not merely in ticks or velocity. This is a point the amateur speculator consistently fails to grasp, to their great expense. Fast, violent spikes rarely establish a durable, lasting habit. They are usually the product of panic or a temporary manipulative thrust, the final, desperate push of a failing campaign to attract the last remaining public interest. The amateur chases the fast move. He desires the rapid profit. The professional understands that stability and endurance require time. If the price is maintaining its direction steadily, day after day, week after week, allowing for those necessary, contained reactions without ever collapsing, then the habit is deep-seated. It is durable. It is supported by the weight of major professional commitment. Impatience forces the speculator to mistake a temporary, unsustainable surge for a lasting behavioral change in the asset. They see a vertical line, they believe they have missed the opportunity, and they jump in. This is the surest route to immediate loss. If a stock makes a 20-point advance in 3 days, that movement is not a habit. It is a burst. It is feverish. It is likely temporary. If a stock makes a 20-point advance over 3 weeks with contained, sensible reactions along the way, that is the establishment of a genuine habit. That advance is supported by observation, careful accumulation, and intelligent waiting. We measure conviction by time. We measure the underlying support by the market's willingness to hold its new ground over days, not hours. The speculator must cultivate the patience to watch the clock, not just the ticks. The habitual indicator works powerfully by observing what doesn't happen. This is a subtle point. but it is the difference between surviving a shift and being utterly destroyed by it. When an asset has established a strong, undeniable upward habit, when it has effortlessly cleared pivotal points and enjoyed contained reactions, we expect it to continue that behavior. We expect the professional interest to remain committed. Therefore, when that stock hits a new high, a price level it has never seen, but then fails to hold that high and rapidly retreats into the range, that is a catastrophic sign. It is the clearest indicator of exhaustion. The price action is telling you in no uncertain terms, the habitual buying has been exhausted. The well is dry. True strength consolidates its gains. True strength uses the new high ground as a launching pad for the next stage of the campaign. It respects its own progress. Weakness, disguised as strength, hits a new high, lures in the last of the amateur money, and then immediately becomes a trapdoor. The professional hands who were holding the campaign use that very high mark as their exit point. Watch the last tick of the highest price. If the tape immediately rolls over and the price action cannot hold the consolidation near the peak, the habit has reversed itself at the worst possible moment for the hopeful buyer. The failure to maintain the new territory is a profound indicator that the psychological path of least resistance has shifted instantly from up to down. A key aspect of reading the habitual action is watching precisely how the price interacts with predetermined, known pivotal points. These are the lines that matter, the obvious support and resistance levels. These points are where the market tests its conviction. Consider a stock attempting to maintain its upward habit against a prior strong resistance level, an old high perhaps that the market respected for months. A weak stock, one whose habitual buying is tenuous, will struggle visibly. It will require immense force, high, unnatural volume, dramatic bursts of buying to break through that resistance. It will linger near the line, testing it again and again, demonstrating hesitation and doubt. This struggle, this painful expenditure of energy, is the indicator of weakness. A stock with a truly robust habit, one supported by deep, committed professional interest, does not struggle. It slices through old resistance with shocking, almost alarming ease. When a price is ready to move, when the underlying habit is strong, the breaking of a major pivotal point should feel effortless. It should clear the line and move quickly into the next territory, leaving the old resistance behind as if it were meaningless. The degree of struggle is the true indicator of the asset's underlying health. If the market is forced to strain and bleed just to gain an inch, the habit is fragile. If the move is swift and clear, the habit is powerful and confirmed. The greatest error the novice speculator makes is confusing the primary habit with the minor habit. The market has a grand overarching strategy, the primary habit, which concerns the long-term trend, the movement over weeks and months. It also has a tactical daily volatility, the minor habit, which is the noise of the day-to-day fluctuations, the brief intraday reactions. Do not confuse the two. The minor habit is specifically designed to trick you. It is engineered to create enough psychological distress to shake you out of a correctly positioned trade. If you are long a stock based on a confirmed, multi-week upward habit, the fact that it pulls back 50 cents on a Tuesday afternoon is irrelevant noise. It is the market breathing. You must internalize the discipline that only the breaking of a major, undeniable pivotal point should signal a shift in the primary, long-term habitual action. Everything else, the daily chatter, the slight dips, the minor consolidations, is simply the movement of the crowd attempting to chase short-term profit. It is static. The indicator is not the small, erratic movement of the day. The indicator is the sustained respect or defiance shown toward the critical price lines you have established. If the stock remains above the major support line, the primary upward habit endures. Focusing on the minor habit leads to overtrading, excessive commission payments, and the gradual erosion of your mental capital. Let the minor movements pass. Wait for the market to signal its strategic intent, not its tactical movement. When a stock is truly committed to its habitual path, its move will appear decisive. It will be swift. Once the pivotal point is cleared or once a reaction is concluded, the action should be an immediate commitment to the established direction. Observe the speed of the confirmation. Conversely, if the asset attempts to break a pivot, say an old resistance line, and then hovers near that line, showing great indecision, that is a warning signal you must not ignore. If the price action looks confused, it is because the professional interest is divided. The sellers and buyers are balanced exactly on the knife's edge, creating an environment of dangerous uncertainty. Decisive moves save you commission. They save you mental capital. They provide quick, clear confirmation that your timing is correct. Indecision in the price action should always translate to indecision in your trading hand. If the stock cannot commit, you should not commit. A stock that spends hours or days struggling to resolve a pivotal point is burning professional money and demonstrating weakness. It is gathering fuel, yes, but often that fuel is used only to briefly cross the line before collapsing back. Wait for the conviction. If the market has true conviction, the habitual move will look easy, swift, and resolved. It will not linger in doubt. When you see doubt in the price, you see doubt in the underlying strength of the habit. This may be the single most important rule in reading the habitual action. It is the difference between entering a valid move and falling into a trap. Never trade the break of a habitual line. Trade the confirmation of the new line after the break. The amateur sees the stock break resistance at 100 and immediately buys at 101/8, fearing they will miss the move. This is speculative suicide. The successful breach of a pivotal point, the true shift in the habitual action, must be followed by a test. The price must prove that the old resistance has successfully flipped its function and is now holding as new support. The market must demonstrate that the new habit is established. If the price breaks 100, the disciplined speculator waits for the natural reaction. They wait for the price to fall back toward 100 to test the sincerity of the break. If the price respects that new support holding firm at 100 or 101/8 and then turns back up, the new habit is confirmed. That is your entry point. If, however, the price breaks 100, moves briefly to 101 and then immediately plunges back below 100, the break was a failure. It was a fake signal. The old habit persists, and the speculators who bought the break have just paid the professional's commission. The confirmation requirement ensures you only act when the market has proven its intent. It removes the impulsive element from your trading and aligns your action with the validated habitual move. Patience here is the greatest dividend. To master this specific indicator, the habitual action of price, you must distill the current complexity of the tape down to a single surgical focus. The clutter of data, the noise of thousands of ticks, the hundreds of possible entry and exit points are all designed to overwhelm your judgment. You must simplify. Ask yourself one question and one question only. Which pivot point, if broken decisively, confirms the continuation or the reversal of the primary habit? Identify that single price level. Draw that line clearly on your chart or hold it fixed in your mind. Let us say your stock is currently trading at $55 and the critical pivotal point, the last major support line that validates the upward habit, is $50. You focus 90% of your attention on that $50 line. If the price is far from it at $55 or $56, you wait. You observe the market's behavior, but you do not act. The outcome is not yet determined. If the price approaches it, moving toward $51, you prepare your strategy. You know the moment of decision is near. If the price respects it, if it touches $50 and bounces immediately, the habit endures, and you remain positioned. If the price breaks it decisively, if it slices below $49.50 and confirms the break, the habit is dead, and you act to exit immediately. This one-point focus eliminates all mental noise. It eliminates the need for any other secondary instrument. You are trading only the intent of the market against the critical line of confirmation. It brings a necessary clarity to the most confusing of endeavors. It prevents hesitation. It dictates your position. The market does not lie. The price on the tape is the ultimate truth. But you must learn to listen to its true voice and not the echoing chatter of the lagging instruments. Stop chasing the shadows cast by derived, delayed calculations. Those crutches only lead to late entry and early exit. Look directly at the price, observe its rhythm. Observe its struggles. Observe its ease of movement, its adherence to or its defiance of the known pivotal points. Master the reading of the habitual action, and you will understand that the market is always providing the only indicator you ever truly needed, its persistent, undeniable intent. The rest is merely distraction. Observe, confirm, and act with patience. Your capital depends upon it.